Do you want to reduce your energy bills? Or maybe you want to use greener energy? Go solar and get a discount. Right now, Which members can get a 7.5% discount on solar panels and their installation if you use Heatable, a Which Trusted Trader approved service. You can also include a storage battery and EV charger, handy if you're looking at making the switch to an electric car. To make use of this exclusive offer, simply head to which.co.uk/solar-offer. That's which.co.uk/solar-offer before the 30th of September 2025. And if you're not already a Which member, you can grab a year's membership for 50% off the usual price. To do that, go to which.co.uk/podcast offer to get involved. Start your solar journey today. Go solar and get a discount with Which.
More of us than ever are taking control of our retirement pot, but is a self-invested pension the right thing for you? Welcome to Which Money. Hello, I'm Lucia Ariano, and joining us this week we have Paul Davies, Which Money's pension expert. Hello, Paul.
Hello.
And also AJ Bell's Director of Public Policy, another familiar voice, Tom Selby.
Hello.
Hello, thank you both so much for joining us today. Well, shall we start from the top then? We're talking about self-invested personal pensions today, otherwise known as SIPPs. Paul, do you want to start us off in a nutshell? What are we talking about?
So it's a bit of a job to demystify what SIPPs are. So I'll start off saying how they're the same as a pension you might know, and then add a little bit about how different they are.
Sounds very simple. No, you put it like that.
Well, let's keep it simple. So a SIPP is a kind of defined contribution pension. So it's similar to the workplace pension you might have or a personal pension, in that you build up a pot, you contribute maybe on a monthly basis, and however much you end up with, you can then convert into an income. So it's a pension that you might know about, and the tax incentives are the same. You have pension tax relief, which is the government topping up your pension. So for every pound that goes in, you'll put in 80p, and 20p will come from the government if you're a basic rate taxpayer. You get even more if you're a higher or additional rate taxpayer. So that's good to know. You get that incentive. So it's the same as the main defined contribution pension. And then when you come to retirement, you can convert that into an income. So it's the standard ways that we've talked about in the past. So you can keep the money invested via pension drawdown. You can take out an annuity, which is a fixed income that's guaranteed for the whole of your retirement, or you can cash in your pot subject to income tax, or cash in chunks at different stages, taking a tax-free amount. So it's a defined contribution pension. So it's the same as the pensions you might know. In terms of how it's different, it's basically a DIY pension. You choose the investments yourself and you manage your investments. So there's much more responsibility.
This might sound like an obvious question, but like other types of pensions, do you have to wait until you're at retirement age to take any of this money out?
So you need to wait until you're at the minimum access age to take it out. That's called the normal minimum pension age in the jargon. So at the moment, that's age 55. That's going to rise to age 57 in 2028 under current legislative plans. And then at that point, you can get your 25% tax-free cash, and you can access the money flexibly in the ways that Paul described. Now, one really important thing to remember, not just with SIPPs actually, but with all pensions, is just because you can get the money doesn't mean that you should. And for a lot of people, there'll be this kind of desperate rush, particularly to get their tax-free cash as early as possible. But actually, if you look at average life expectancies, if you're accessing your pension at age 55, that money might need to last for at least 30 years, if not 40 or potentially 50 if you're lucky and you live towards your 100th birthday. So 55 is the earliest point you can access, but that shouldn't necessarily be a trigger for you to take your money, because you're going to need to think about making sure it lasts as long as you do.
And shall we talk a bit more then about why you actually might want to get a SIPP? So we've mentioned that you have more control over where your investments go. Can you talk to us a bit more about what that actually means?
Yep, sure. So full disclosure, AJ Bell is a SIPP provider, so I'll get that out there to start with. There are lots of reasons why people choose to invest in a SIPP. So usually if you're working and you're automatically enrolled, then you might only choose a SIPP for contributions over and above those you have in employment, because in employment you get those matched in contributions from your employer, and if you go into a SIPP then you won't get those. So for people who are employed, they might choose to go for a SIPP for contributions over and above those ones inside their workplace pension. Of course, if you're self-employed, then you're not covered by automatic enrolment, so a SIPP might be a good option for you. And also for people who are looking to combine their pensions when they come to retirement, I think the choice and flexibility that you get in a SIPP can be really attractive. So for most ordinary workplace pension schemes, there'll be a limited number of investment choices there. Some won't offer all of the different retirement income options that are available, and there'll also be different services around the pension that you get as well. So different SIPP providers will offer different levels of support to you, different levels of content, a different overall customer experience. So there's lots of different things, from choice to support to content to flexibility, that you can get with a SIPP that you might not be able to get with your ordinary workplace pension. And of course, as I said, some people don't have access to those workplace pensions at all. So both saving for retirement and when you're coming to retirement and wanting to turn your pension into an income, there's lots of reasons why people would choose to go for a SIPP, because it offers that flexibility and choice that lots and lots of people really crave.
Shall we just confirm, or I'd like to hear your advice, if you do have a workplace pension and you're auto-enrolled, so your company's also putting money into it, is it a no-brainer that you take that and you go for that over, say, getting a SIPP?
So for most people, that it will be the only option in order to get the matched workplace contribution. So as Paul said, the tax incentives are the same, so you get the same tax relief in a SIPP as you get in a workplace pension. But if you're playing into your workplace pension, then you get that 100% bonus of the matched employer contribution. If you chose instead to invest in a SIPP, then unless your employer was willing to direct that matched contribution into a SIPP they'd chosen, now some will do that, but the vast majority don't, then you'd essentially be foregoing that employer contribution. So it's something that technically you can do, but it's not something you'd ever suggest someone should do, because that employer contribution is one of the big incentives for saving in a workplace pension.
And it's interesting, I've got here that more people than ever are doing a self-invested pension. Paul, how popular are they, and why is this popularity increasing?
So you're right, it's increasing. Back to the point of why people take out SIPPs, we actually asked SIPP holders that recently, and the biggest factor, 56% said that they wanted more control of their pension savings. So it's back to that control point. 45% felt that they could improve their pension performance. So it's actually proactively taking hold of your pensions. And 40% said that combining their pensions was a good idea in terms of convenience. So I boiled it down to the 3 C's actually: convenience, control and charges, which we'll talk about in a little while. But if you look at those 3 main points, that's the reason why people are increasingly turning to SIPPs. And yeah, the numbers back that up. There's estimated 5 or 6 million people have a SIPP now in the UK. And looking at the figures for people opening new SIPPs, so the FCA data from 2023, which is the last release, I think there are 865,000 new SIPPs opened in 2023. So, not far off 1 million new plans being opened every year. So the product's really moved from quite a niche product, probably 10 years ago when the pension freedoms came into being and lots more choice and flexibility were introduced to the system. So, only relatively few people had SIPPs. Now, as I say, almost 1 million new plans are being opened each year. So it's very much, more in the mainstream. And again, we asked people how long they'd had their SIPP. And I think 43% only opened their SIPP in the last 3 years. So again, it's really building up into something that more and more people are considering for those reasons, for convenience, for for choice in terms of investments, and in lots of instances lower charges.
And that point you made at the start about control, people wanting control, what's behind that? Is it largely maybe wanting to know your investments are aligned with your values, or?
Yeah, so again, Tom mentioned about in most workplace pensions or personal pensions, you will be put into default funds, which is okay for most people in that the decision is taken out of your hands. But if you want to be more proactive, if you're interested in investments, most SIPPs have a much broader range of investments. You've got shares, you've got investment trusts, you've got different types of funds, you've got bonds, ETFs. So there's a huge range of investments. So if you do have that confidence, you know that by signing up to a SIPP, you've got this huge portfolio of potential products that you can invest in. For most people, being in the default fund within their pension scheme is okay. But if you want to, take more of a role in your investments in the future, particularly around your pensions, then SIPPs might be for you.
Yeah, and that control point, I think, I agree with everything Paul said there. That control point for a lot of people will be around taking a retirement income as well. So not every pension scheme, and certainly not every workplace pension scheme, for example, will offer income drawdown, so allowing you to access your pension flexibly to meet your needs. So for a lot of people, as they approach retirement, they think, how do I want to access my pension? The vast majority of people today, the FCA stats suggest, and in our experience, do want to keep their money invested, at least in the early years of retirement, and take a flexible income to match their needs. So for some people, it will be a necessity for them to look to a SIPP or away from their workplace pension, because that's how they want to access their money. So it's, I think, control when you're saving in terms of the choice of investments and the different options that are available. But I think for a lot of people, it's really crucially control when they come to the point when they want to turn their retirement pot into a pension income.
And so for any of our listeners then who are thinking, okay, maybe this might be for me, starting off, like, how much time and effort might this require? How easy could it be?
So in terms of setting up a SIPP, it's really straightforward. So you'll just need a few details. So your national insurance number, your bank details, your employer's details, and usually your debit card details as well. You can set them up for very low cost. So for AJ Bell, it's a £25 direct debit or a £500 lump sum, and you can set up your SIPP. And then the question of how involved it is once you've set it up really will depend on your needs and whether you're saving for retirement or you're taking an income, particularly through drawdown. So if you're in your 30s, for example, and you set up a SIPP and you've got a regular direct debit going in, so regular contributions going in, you might choose a simple multi-asset fund, so a single fund that invests in different stocks all around the world. And in that case, as long as you're happy with the risk attached to that fund, so usually you'll have a low risk to high risk and various other versions of these types of funds, then actually it might be reasonably low effort for that period of time, because as long as you're comfortable with the fund you've chosen, it's just a case of putting the money in every month. And if you've done that by direct debit, actually for a lot of people, the best thing to do is to leave it alone as long as you're comfortable with it and let compound growth over time work its magic. When you come to taking an income in retirement through drawdown, that's when engagement is absolutely crucial, regardless of if you're picking individual stocks. So if you're picking individual stocks as you're building up a fund, clearly you're going to be more engaged. If you're picking a fund, you might be less engaged. But either way, once you're in retirement and you're taking an income, you need to be engaged with your investments. You need to be particularly engaged with your withdrawal plan, as I've mentioned earlier. So if you're accessing your pension, you're taking money out of your pension and it's still invested, then you need to be checking up on it at least once a year to make sure that you're not at risk of running out of money in retirement. Now, that's a very difficult thing to figure out because none of us know how long we're going to live, but you can't just go into drawdown and assume everything's going to be okay if you take out 10% a year, for example, because in all likelihood, your money will run out in retirement. So particularly in that taking a retirement income phase, you need to be willing to be engaged and you need to be up for that challenge, really. The danger is if people go into drawdown and they think that this is the same as buying an annuity, so a guaranteed income for life. It's not. The rewards are there, the flexibility's there, but you have to accept that engagement is going to be needed for you to make the most of that.
But it's worth adding, there is some help available in terms of AJ Bell have got 15,000 shares. You can look at 5,000 funds, but there's ready-made pensions, or ready-made portfolios, which are pre-built investment portfolios that the company puts together. And you can pick these in terms of your age, in terms of your risk profile, in terms of when you're looking to retire, maybe what you're going to turn your income into certain products. So these are pre-built plans that you can sign up to within the SIPP. So if you're confident enough to open a SIPP but want some help from the provider, there's some shortcuts. There's some help that you can get. Yeah,
that's a really key thing, I think, is that historically, so going back to that kind of 10 years pre-pension freedoms era, SIPPs were mainly for high net worth people who were really engaged, and the majority of people were picking individual stocks and bonds and building a portfolio, and were almost hobbyist investors. Now those people are still catered for, so you've still got that whole choice of funds and investments if that's your bag, if that's what you want to do. But increasingly that kind of wall of people who are coming into SIPPs actually just want something a bit simpler. They want to do the right thing, they want to save for retirement, they want to get to a point where they can take a retirement income to suit their needs, but they don't want to go through researching 4,000 funds. I mean, I know I don't, for example, I think, and most people don't want to do that. They want to do the right thing and save for retirement, but they don't want to spend their whole time monitoring their portfolio every 5 minutes and trying to time the market and picking different individual stocks. So you've got all of those different needs are catered for, depending on if you really want to be picking your own funds, or if you just want something simple that's broadly going to work for someone like you.
And something that comes up whenever we talk about pensions is how so many of us might have a number of different pension pots from previous jobs dotted all over the place, myself included. I mean, could opening a SIPP be the answer to that?
So it can be, yes. So AJ Bell and other companies as well have pension finder tools that are free for our customers to use. So you just need to put in your old employer's details, a little bit of information about yourself, and then we as a provider will do the searching for you for your old pension pots, and we'll bring them back and say, okay, you've got this pension pot from employer X, this pension pot from employer Y, this pension pot from employer Z. You can see them all there, and then you can essentially at the click of a button choose to combine them with AJ Bell into a single SIPP. Now, whenever you're going through that process, there's lots of things that you need to be aware of. So in particular, if you're combining older type pensions, sometimes they've got quite valuable guarantees attached. Doesn't tend to be a thing with modern auto-enrolled pensions, but certainly if you opened a pension in the 90s or early 2000s, you might have one of these valuable guaranteed annuity rates attached. Now, our service will flag that with you. So if you've got this valuable guarantee, we'll let you know you've got it, and if you transfer, you will lose it, and then it's up to you whether you take that decision. But particularly in the last kind of 5-10 years, that whole process of identifying your old pensions and then combining them has been made a lot simpler by the industry. Now I know we've talked about it before, there are government efforts to try and make this simpler as well, through the creation of pensions dashboards, which will allow you to see them all in one place. But in a lot of ways, the industry's already moved to fill that gap, because there is this clear need by lots of people who've got 5, 10, 15 pension pots dotted around the place to get them all in one place so that they can plan for the future. And actually, there are lots of different reasons why you may want to combine your pensions, but the most important one for most people is simplicity. You just want the idea of having 10 different bank accounts during your life is an absolute nightmare. And it's the same thing with your pension. Most people want to have everything in one place so that they can make an easy decision about where they invest it and how they access it. And the SIPP market in general has moved to help people do that.
Now, we've been reviewing the best SIPP providers on the market. And before we get into the details of how we've done that and, what our listeners should be looking out for, Paul, do you want to mention some of the table toppers?
Yeah, so we look at two main elements, a customer score, whereby we ask people who own SIPPs whether they'd recommend their provider and how satisfied they are. So a score of 70% plus and in one of the top statistical bands is essential. And we also look at charges. We look across 7 pot sizes, starting from £25,000 up to £1 million to see what the standard platform charges are. And any provider that's in the most expensive 25% across all of the pot sizes we exclude from being a which recommended provider. It's interesting, Tom mentioned about pot size and SIPPs being more mainstream. The average SIPP pot size in our research was £230,000, which sounds huge, but if you think of a lifetime of pension savings over a 40-year career, and then perhaps combining all your pensions into one, it shows that these products aren't just for the high net worth, really wealthy people. It's something that lots of people are considering now. So those are the two key elements: customer score and charges. And with that, we whittled down from the 16 providers in the research down to our 6 recommended providers for this year.
Can we reveal those?
Yes, so the companies are Fidelity, Barclays Smart Investor, AJ Bell.
Thank God. That would have been awkward, wouldn't it?
That's a relief, isn't it?
Thanks for the brown envelope, Tom. Halifax Share Dealing, Interactive Investor, and Vanguard. So we've got 6 companies. Fidelity, AJ Bell, Interactive Investor, and Vanguard were recommended providers in preceding years, so they're renewals, if you like, and the other 2 are new entrants this year.
And can we go a bit deeper then into fees and how these fees might compare to other pension pots, other pension providers you use? So
there'll be a variety of fees across different SIPP providers. So different SIPP providers structure their fees differently. So some will charge you a percentage fee, some will charge you a flat fee, and those percentages and flat fees vary from provider to provider. So sometimes that can make it a bit tricky for people to compare across the piece. So you're comparing a percentage charge to a pounds and pence charge. That's not always straightforward, and it's actually why guys by you guys and others are really useful for consumers. And I think for people choosing a SIPP provider, that cost and charges piece is really, really important, and making sure that you're comfortable with the fees you're paying, and they're in and around the kind of best in the market for your pot size is really crucial. Now, there are clearly other things that people consider when they're choosing value for money. So you don't necessarily just go for the lowest cost option. You want to think about things like the service that a provider's offering you, the choice that you have, the flexibility that's there. And I know for our customers, one of the big things that they want is a human being on the end of a phone reasonably easily if they run into a problem, because we all know that SIPPs, pensions generally, can be quite complicated, particularly when you're looking to turn your pension into a retirement income. And so we place a significant emphasis on making sure that where people need to contact our customer call centre, they get responded to quickly. So that's something that we'll try to do, is kind of to offer extra support to people. Other providers will offer different levels of support at different price points. It's never straightforward for people to choose their provider because there's so many different things to think about. But it's just important for you to consider what is important to you and then choose your provider based on those things that really matter to you. But costs and charges always going to be a crucial part of that.
And how do the fees for SIPP compare to the other types of pensions? Would you say that you know that they're more expensive or about the same, or what kind of baseline are we talking about here?
Yeah, it depends on what you choose to invest in. So if you look at, I guess, workplace pensions would be the obvious comparator. So they have a charge cap of 0.75%. Lots of workplace pension providers charge less than that, but that's the maximum that you can be charged. Now, if you're choosing your own investments within your SIPP, there won't be that charge cap in place. But it's incredibly straightforward if you pick a low-cost provider and you invest in, for example, a tracker fund or in a multi-asset fund that applies these tracking investments. You can easily build a balanced portfolio that's based around your risk appetite that is 0.5% or less. So it obviously, if you choose investments that are more expensive, then your charges will be higher, and that's a choice that you're making. But if you want something that's low cost, then you can get something that's easily comparable with a workplace pension, if not cheaper, if you go down that tracker route.
Yeah, that's a good point. It's worth remembering the other fees that you might have to pay. So, Tom's just bolted together the platform fee. Perhaps you're paying 0.3% as an average for the platform fee, and then 0.2 for a tracker fund. So it's in the ballpark, and quite often less than your workplace pension. But there'd be fees for buying and selling investments. So that might be £5 or £6 per transaction, so you'll have to remember that. And if you go, for example, for a managed fund, you'll be paying much more than the 0.2% we talked about. It might be nearer 1%. So there's different types of funds, and they carry different charges. But you will have to sit there with your fag packet and do some calculations. We try and take some of that work on, and obviously with our guide we've got platform charges across different price points, as I mentioned, but it's quite tricky to put all the charges together sometimes.
So of course there's charges, and we've mentioned other things like customer service. Is there anything else that you'd like to flag as something listeners should be looking out for?
You have to say that this type of pension isn't for everyone. We've talked about it being more mainstream, but it's for savers who feel comfortable choosing and managing their own investments. So I think that's the bottom line. We're not selling this as something that everyone should go for. And if you're not confident, maybe you should leave it to the trustees and their advisors, or the pension company that will choose default funds. So that's your alternative, if you like. You can also go and see a financial advisor who will help you choose a SIPP. It doesn't have to be completely DIY from the outset. You can choose a SIPP in conjunction with an advisor who might help you at the outset, or might help you on an ongoing basis with your SIPP if you need to rebalance your investments. So there's alternatives if this isn't for you.
Good to hear a word of caution there. And Tom, I suppose on the flip side, if anyone listening is thinking, this might be for me, but I'm finding it a bit overwhelming, what advice would you give?
So don't be overwhelmed would be the first thing to say. So yes, these things have lots of elements to them, and yes, they can feel complicated. But actually, as we discussed earlier, if you want to simplify the whole process, you really can. Now there are lots of really helpful independent guides out there. So the Money Helper service, for example, is a really useful resource for people to use. It not just if they're choosing a SIPP, but if they're thinking about retirement investing in general. But I would keep hammering home that point that it doesn't have to be as complicated as it feels. So you guys have done a really good job here of kind of covering all the various different things that people might have to think about when they're choosing a SIPP. But actually, for lots of people, it can be really, really straightforward. It can be a case of find one that's low cost, that you trust and that you're happy with, open it up, pick a fund that matches your risk, and away you go. So it can be complicated and involved. There's lots of things you have to think about, but don't be overwhelmed or intimidated by the process, because it doesn't have to be as difficult as sometimes it looks at first sight. And I think generally sometimes the word pension gets put in front of people and they just throw their hands up and think this is all too difficult. And actually the key things that most people need to know aren't that difficult. And if you're doing the right thing and saving for retirement, then you're going to be putting yourself in a good position when you get older.
And I suppose the last thing I wanted to ask you about is any other kind of alternatives to SIPPs or workplace pension for saving for retirement. So, maybe the LISA or just other types of investing. I suppose any advice there on whether to take those options?
In terms of alternatives to the workplace pension, I'd say a pretty clear no, because of that employer contribution that I mentioned. So you shouldn't be opting out of your workplace pension and going into a SIPP or a lifetime ISA. The lifetime ISA is a really interesting one. So if you're self-employed and you're a basic rate taxpayer, then you get the same bonus on a LISA. So there's that same 80p turns into a pound that Paul talked about earlier in a LISA as you get in a SIPP, and you can access the money completely tax-free from age 60. So if you're self-employed and you're a basic rate taxpayer, then that is quite a compelling choice versus a SIPP. So is something that people should potentially consider. Now, there's different rules around it, different access points, a different amount that you can pay in each year. But for some people, that will be an attractive option.
Just while you were saying that,
Yeah.
I just thought if you're a basic rate taxpayer, that seems like maybe a no-brainer. But if you're a high rate taxpayer,
so
not
you don't,
so much.
you get no, because you'll get the bonus that you get is less. So you get 40% tax relief in a pension. The bonus in a lifetime ISA is the equivalent to 20%.
That's quite a good
tax relief.
distinction to make, then, isn't it?
Yeah. And then there are other things. So ISAs, so ordinary ISAs, a more flexible option. So if you want to save and invest, but you want that kind of off valve to be able to take the money out in emergency, then an ISA may be an attractive option. And then there are more complicated vehicles like venture capital trusts and enterprise investment schemes, which I'm not going to go into.
I don't think we've really mentioned this before on the podcast.
much higher risk type vehicles, but the kind of vehicles that, particularly for people who are, for example, using up their entire £60,000 annual pension allowance, might consider if they want to get some extra tax incentives. But those are the kind of things where you really need to take regulated financial advice in order to go into them, and you need to be absolutely comfortable with the fact that you're going to be investing essentially in higher risk companies which may succeed but may completely fail. So for most people, it will be the mainstream options of pensions, so SIPPs or workplace pensions, your lifetime ISA or an ISA.
Anything you'd like to add, Paul?
No, it's Tom mentioned the self-employed. We haven't really talked about the self-employed, but obviously the employer contributions won't count there. So SIPPs might be appealing to that group, and lifetime ISAs. So if they haven't got a pension, opening the SIPP, obviously they get the pension tax relief. But then all the other bits we've talked about, seeing all your pension value in one place and all your investments. I guess that's another driver behind the rise in SIPPs over the last few years.
Well, it's been a great episode, both of you. Thank you so much for joining us and breaking this down for our listeners.
Cheers.
Thank you.
Thanks for listening to this podcast from Which, the UK's consumer champion. You can find plenty more advice about what we discussed today in the show notes. There you'll also find a link to become a Which member for 50% off the usual price, an offer exclusively available to you, our podcast listeners. Joining Which will not only give you access to our product reviews, our app, one-to-one personalised buying advice, and every issue of Which magazine across the year, but you'll also be helping us to make life simpler, fairer and safer for everyone. Don't forget to hit subscribe wherever you're listening. That way you'll be notified whenever we release a new episode of Which Money, Which Shorts, or any other podcast that we make for you. And if you want to get in touch with us, then follow us on social media at Which UK or drop us an email to podcast@which.co.uk. See you next time.
If you're enjoying this podcast from us here at Which, then why not become a Which member? Right now, we've got a special offer, especially for podcast listeners, meaning you can choose any of our 3 membership tiers for 50% off the usual price. Starting at just £39.50 for a full year, you can get Which magazine delivered direct to your door. For the same price, you could also choose a digital Which subscription, giving you access to all of our product reviews, the Which app, and the digital edition of Which magazine. What's more, you'll also be able to use the Ask Which service for personalised one-to-one buying advice. Or why not get a full access Which subscription for just £49.50 for a full year? Don't forget, that's 50% off the usual price. To join Which or to find out more, just head to which.co.uk/podcast offer. That's which.co.uk/podcast offer. Or click the link in the description for today's podcast for 50% off a Which annual subscription.